Okay, good morning, everyone, and you're very welcome to our first Coffee Microcaps webinar virtual event for 2025. I hope everybody had a good break over the last few weeks, and everyone refreshed and ready for reporting season over the next couple of weeks. I'm just going to quickly run through a couple of intro slides here, and then we're going to get straight into it with our first presenters this morning. For anybody who doesn't know, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and you're all very welcome to this morning's event. I'd like to mention RAS Research as a Service, our virtual event sponsor here, Coffee Microcaps. If you're looking for coverage of some small and microcap stocks that's maybe not covered by the rest of the sell side broking community, please do check out their website for their free research. Quick compliance and disclaimer slide, and a very welcome to our friends from ASIC for this year. For anybody who is joining us for the first time, the companies we tend to have presenting on here every other week, capped under 300 million, our definition of a microcap, they're generally revenue heading towards cash flow break even, or indeed are already profitable. We tend not to have companies from the resources and biotech sectors, so what I like to call industrial microcaps, which kind of covers everything else from tech, healthcare, retail, professional services, and hardcore industrial businesses. Structured this morning's webinar, we've got two companies presenting this morning, 30 minutes each, which we're going to break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for our presenters, please type them in the Q&A box rather than the chat function. It does make it just easier for me to moderate the questions at the end. Please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials. Twitter's our main one. YouTube, as I said, for the recording of this webinar. Indeed, all our previous stuff as well. There's well over 150 webinars up there now. LinkedIn, and I do write a free monthly newsletter that you can get on the Substack newsletter platform. I'm delighted to welcome our first presenters this morning. ReadCloud, we've got CEO Andrew Skelton and CFO Luke Murphy. And then after that, we're going to switch from Melbourne to Adelaide, and we've got Sean Ebert from AL3. So I'm going to stop sharing my screen and hand over to Andrew. Andrew, if you could just please bring up your slides. I'll let you know once they're up. Yeah, it's just loading now, Andrew. Yeah, I can see the cover slide of your presentation now. Andrew, you can take it away.
Fantastic. Thank you, Mark. Thanks for the opportunity to talk today, and thanks everyone for joining. So we're ReadCloud. We listed in 2018. We're an EdTech growth company. I'd say since 2018, we've learned a lot about ourselves, actually. We've turned from a great idea into a strong and growing business. We're now self-funding. And we're growing strongly. We've got double-digit growth, and our platform next year is embraced by 430 schools and growing. So what are we? For those of you that don't know, we provide three services via our sort of core technology platform. One is we're selling textbooks into schools. We are a digital-first company, so we provide digital textbooks. We can augment that with physical textbooks when we have to, but we see the growth and the excitement, and our differentiation comes from the digital environment. So that's where we're strongest. And it turned out that by building a reader and by building engagement tools for students and teaching tools for teachers and trainers, we can actually deploy that same technology platform into the vocational training space. And that's been a really ripe hunting ground for us. And we've got a sort of supercharged, high margin, high growth business in vocational training, which we really like because each year in Australia, there are more than 250,000 high school students that engage in vocational training at school. And that's where we're seeing some really high growth, and probably where we have our strongest differentiation. So that's been turning into a wonderful business for us. And we can take that same technology and the content and a lot of the process and also deploy that into industry training. So it looks a little like this. If you want to think of, well, how our growth platform works, how it's deployed, we think of it in the middle. We've got all our technology around books and content. And the top half of this diagram is, this one's talking about vocational training. Most of the content that we use in vocational training, we create ourselves. So we have a learning and assessment team that's covering 50 different qualifications that are available to students in Australia. We supplement that with some third-party publisher content. So where a field is really specialised, like electrotech or even automotive, we tend to buy that curriculum in because it's just more efficient than trying to make up those sort of highly specialised areas. So in the middle is our technology that students access, that teachers access, that schools access, that administrators can access. It serves up that content. It enables teachers to manipulate that content. It enables sort of classwork, annotation, engagement around that content. And then there's a layer of services we provide. So from certificating at the end or providing the awards, or the industry connection or the industry engagement steps that a VET course must take or must have in its background, the RTO, administration, the reg compliance, all those services are wrapped up in what we do. Below the line was our initial business, and that was the ebooks business before we leveraged into vocational training. And that is all publisher content. So we have access to 43 of the world's leading publishers for academic content. That's actually really valuable. There's not too many people that have that. And we provide those books to schools. We started in Australia, and in recent times, it sort of dawned on us that the same technology applies equally well. In fact, in some cases, better internationally. So there is a global opportunity, certainly for ebooks, which we're just at the beginning of exploring. Go down one. So just recapping where we've been. We mentioned we've been on a bit of a journey since 2018. Last year, we started to see the strength coming through. You can see that sales and fee revenue growth up 15%. It's all organic. We had a good year on cost management, but one of the real bonuses of getting cost out was it just helped nudge us. I mean, we took strides to get closer to the customers, but you remove cost, you remove distraction, you remove things that aren't really helping. It actually helped us get even closer to our customers. And that's one of the things that's sort of fueling our growth moving forward. So we had our first positive earnings result, reasonable improvement there, similar with cash flow, and enough funding to do what we need to do. So our focus is really on cost discipline. And you can see a solid improvement in our operating costs as a percentage of our revenue. And that's something that we value and that's important to us. We want to keep working on that improvement going forward. That's been improving for sort of 3 or 4 years. That momentum we think is here to stay, or certainly our mindset. Our retention rates are strong, and most importantly, getting better. So they were down at 69% in ebooks a couple of years ago. And there's been a bit of a step change there, and it's trickling upwards from here. The sales capability is something we're working on as well. We've been pretty raw. What I think should give people confidence is that in FY24, we had 15% revenue growth, whilst our operating expenses reduced by 6%. And that was based on a group-wide marketing spend. So across ebooks, across the school, the vocational training and school sector, and across industry training. In total across those three was 122,000. So very modest. It's not as if we have to splash cash to get growth. We've got a lot of optionality here in how we accelerate, and we'll do that quite deliberately and mindfully. We're now at a stage where we've sort of got our business humming along. Our processes are bedded in. Our customer base, I mean, we mentioned the retention. They're getting more and more used to our technology. They're engaging with it better and better. It's actually freed up some of our content creators, if you like, some of our sort of regulatory navigators to generate some new products. And what's exciting here is we can see a trend in the market. We've launched new courses for 2025 and attracted new schools and actually upsold existing schools into new courses. And we mentioned here pathway programs, which is a ripper for us because our Vet in Schools business is really limited to year 11 and 12 kids. We haven't had an offering for year 9 and year 10 kids. We now have a product launched for year 9 and year 10. There's some early adopters that are coming online in 2025. We'll run about nine qualifications at this point. But as schools have that runway to incorporate it into their timetable, which is usually a 1 or 2 year process, we think in 2026, certainly in 2027, we're going to be providing qualifications into year 9 and year 10, which it's as simple as it sounds, doubles our addressable market in that sector, being the vocational training in schools. So there's real momentum in there. And one of the reasons we are very happy focusing in that business is the gross margins are above 90%, and we expect that to continue. So just checking in on our early progress against those areas of acceleration, those areas of focus, like what we set out to do, is it working well? Here's our first quarter results. So we're a September 30 year end. So we have 1 quarter's worth of results to kind of validate our approach. And you can see here, well, we've had a record December quarter, strong increase in cash receipts and revenue, operating expenses up 1%, which is not bad following a 6% reduction. And given the growth in the business, we've got 55 new schools starting with us this year. Retention rates are solid. And our industry training business had a stellar year last year, and that's sort of consolidating its gains. And if we look in particular at the Vet in Schools division, that's going to deliver growth above 25% this year. We've mentioned the gross margins. The annual recurring revenue coming out of that business is going to be above 15%. That's a really healthy sign. In that segment, we've got 52 new schools joining this year, so we can see the growth. And those new schools are doing more business with us than the new schools did in the prior year by quite some margin. And look, it's going like all our indicators for 2026, like our pre-sales, the intentions to deliver in 2026, they're looking really strong. We're anticipating that growth rate in that business is going to continue. So our focus for the balance of the year, it's really about strengthening those annual recurring revenue streams. So really engaging even more strongly with our ebooks customers, engaging more strongly with our Vet in Schools customers. We do that in a number of ways. There's a lot of support. There's a lot of engagement because our tech is our own tech. It's proprietary. And in one of the businesses, because so much of the content is proprietary, we're really able to go deep into the service offering, deep into, well, what do the students, what do the teachers, what do the schools value, where are the trends, really work with our customers and bring those things to life. The cost discipline, we've mentioned that is important. I think our owners have been patient. Now we're self-funding, now we're growing. The benefit of that needs to go to the right places. We've got a real opportunity to drive home the differentiation that we've created in Vet in Schools. That's a large market. We think that market's growing in relevance with vocational training. And that's a key area of focus. That's a very good place for us to invest and grow in this year, and I think for the foreseeable future. In ebooks, we've got a robust business now. The tech's working. We've learned a bit more from our customers. We've got some strong publisher relationships. There are opportunities internationally to target some categories. We just want to be really quite deliberate on, well, how do we pick a small number of projects or tasks or opportunities that are going to accelerate growth in the most economic way. Marketing, now that we know we're keeping the customers that we win, we think we can accelerate our marketing, and that also sort of feeds into your sales force and get those, keep those growth rates strong, keep the new customers coming in. That's got like several years of runway, we believe, given the importance of the education market and that sort of ongoing transition into the relevancy of vet in schools. So just as sort of some broad markers, we've previously expressed we've got a baseline revenue growth target of 15% plus. And we're talking organic, of course. But what we really like here is our ReadCloudVET business. It's now a high growth, high value business, and it's really differentiated from its competitors. So if we look ahead, probably the key things I'd note is our customers are really resilient. Lead indicators, particularly for 2026, are really strong. Retention rates are, they give us the confidence to invest. They give us the confidence to go out and sell more, put more effort into sales and marketing. We've got that operating leverage really starting to come through. And look, we're self-funded, and we've done the work in terms of technology, in terms of content, even in terms of culture. We're now positioned to accelerate. So we're really liking now being at ReadCloud, well, I am at least, and be pleased to talk about it more. Please fire away with your questions.
Yeah, thanks, Andrew. Questions have been flying in there thick and fast, so I'll start at the top and we'll just work down through them. The 59 new schools signed as announced in the 4C last week. Somebody just wants a bit of context on, how does that compare to last year? Were you starting 2025 with, at 50 or 60 new schools because obviously January started the school year, is that kind of comparable to where you were kicking off 2024 to?
Yeah, we had around we have 35 in vet, and yeah, we had less than that last year. We had sort of around the 50, approaching the 50. But what's different is the retention, right? So there's not a lot of excitement if you're adding 50, if you're losing 50. Right. So we didn't quite lose 50 last year, but the retention wasn't what it is now. So two things are happening now. We're tending to keep our customers, and the customers that we've kept are doing more business with us. So we're really emboldened by that 59, and incidentally, it's trickling up. Even at this late stage, we're getting a few more in. So that number's improving. So the number is stronger than last year, not materially, but to give you a marker, and it's in the deck, the new schools in vet in schools, the business they're doing with us, so the revenue we're going to draw from them is 55% higher than the revenue we drew from new schools in 2024. So it's more about the value of those customers and their stickiness. That's where the biggest uplift is. But 59 new schools a year, we keep doing that. We keep doing that on the back of what we have. That's a real business. So we're already, like our tech platform, we're selling it ourselves, and there's some other sort of resellers that do bits and pieces of it, but we're selling it ourselves now into 430 schools. So this is now a real business, self-funding, off to the races. But hopefully that gives you some context on the school numbers.
Yeah, maybe I'm going to skip down to a question here. I think it's a good follow on from what you were saying there about, kind of total number of schools. There's a question for the vetting schools. You say there's 250,000 students every year. How does that kind of translate into, a total TAM opportunity of, how many, obviously the vets are, different in every state, New South Wales,
Yeah.
Victoria, but if you kind of add them up in a kind of nationally, and the courses that you're focused on, what does the kind of total addressable market kind of look for ReadCloud in that section of the business?
Yeah. So the total addressable, it is that 250,000. At the moment, as a reference, we did, in 24, 15,000 students are using our vetted schools. Right. So there's a lot of uplift. Now we're strong in Victoria. We're strong and established in WA. In Northern Territory, their government is increasingly interested in our tech platform. We've solved some problems for them because, again, because we're end to end and because we have the resources to drive tech, to drive content, we've solved a number of challenging problems with the NT government. Now, it's not the biggest market for us, but they're trying to engage more and more with us. They now want us to showcase their tech, I think, next week up there to take our program there broader. In South Australia, we have a bit of a beachhead. We've got some schools. I think we're around 20 schools now in Queensland. So we've sort of got our entry into that market. Queensland's a big vet market. And the other one that we haven't cracked so far is New South Wales. So we have a couple of plans on how best to get in there. There's still, we can confidently say this is a double-digit growth business. We can see the growth coming through. We know it for 2026 already is sort of what the baseline is going to be from the intentions. I think in 3 or 4 years' time, we're going to need to have cracked into New South Wales. But because we're driving our own tech, because we're driving our own content, because I guess our reputation or our standing, the work we're doing with departments of education in various states or the Catholic school system, particularly in WA and Vic, it has a bit of a halo effect and it's helping us launch into other states and territories. And New South Wales is probably the last holdout, but we've got, as I say, 3 or 4 years to work on that, and we are, before we're going to need to open that market to maintain our growth.
Okay. And then just a question on, I know you didn't touch on it too much, but the Southern Solutions training business, what drove the revenue growth there? Was it, just onboarding of a lot new customers, and maybe touch on, the outlook and the growth potential for, for that business as well?
Yep. So what drove the revenue growth? We've got a decent team, but it was a relatively new acquisition. I think it's sort of just over 2 years old. And it just had, I mean, you might say it kind of meandered. We had a close look at it and said, hang on, this thing has to get back on track. Some things are relatively straightforward. They're just effort plays. We put effort into getting closer to customers. So some large sort of childcare groups began to embrace our services. One of the differentiators in that business is that it is more national than most of its competitors. So if you are a national childcare operator, you can deal with one group, one set of tech, one escalation, one set of services that covers New South Wales, Victoria, Queensland, South Australia. Right, that's actually unusual in the space. So we picked up quite a number of childcare groups. There's opportunities in aged care, similar thing, but that's not the safest place to play. We sort of preferred the childcare group. There's some other bits and pieces. We've just done some basic business development work. We've streamlined the way we manage trainers, which results in better outcome, better throughput, more efficiency in that business. But here's what I'd say about going forward. If you weight up our 3 businesses and you look at the total addressable markets, you look at margin, but probably most of all in that business, you look at the whims of government. Ebooks, super resilient. It's almost impervious to shocks and changes and politics. Vet in schools, actually very much the same, like more than you might first think. But in industry training, I mean, you might hear the argy-bargy between government-funded TAFE or free TAFE, and you've got to get government funding to really make those businesses pop at usually the state level. And so it's just a business we look at and go, well, our capital and effort is better off being put into the higher margin vet in schools business or the global opportunity ebooks business. So what we like about Southern, look, it leverages our tech, it leverages our processes. It's not a bad business, right? But it's not where we want to see the growth, or it's not where we prioritize the growth.
And then just a question from my side on the international expansion into, a few of these markets is, what can we expect there in like FY25? Is it going to be new markets, or in the countries that you listed there, is it, building out maybe the beachheads that you've got there, and trying to win new customers, and or sell more products and services, like you do in Australia, into those existing customers.
Yep. So we like that business. It's attractive. The margins hold up quite well international. There's probably a little more in it than in domestic. But we're timing our run. We've got to take our lessons. I think there's a little more we can refine from our work with King's into High. We want to really bed in the Australian International School in Singapore really well, so that when we do hit the ground, we've got everything like really top shape, because we want to have one crack at it and we want it to be right. We don't want to sort of burn funding up. Like we mentioned, we spent very little on marketing. That moves upwards this year as we're more confident in our retention and we're more confident in our product, but it's still got to be done in a way that it's very important to us to be self-funding. It's very important to us to preserve margins so that it's the owners that are getting the benefit of the growth. So it's a staged approach. We are being more active in marketing internationally this year, but it's quite staged and nuanced. I think it will take 2 and 3 years to really bed that in and get a growing business. We know it's there. We want it to work as soon as we start kind of ramping up the investment. What really sets us apart there, and it's surprising the lack of alternatives in this space, but if you have either students in more than one location, which a lot of international schools do, and there's 14,000 international schools that teach in English. So where we have the publisher relationships, we've got an addressable market of 14,000 schools. A lot of those, they have their kids in more than one geography, which makes a digital textbook solution far more appealing than the logistics of trying to get the right version of the right book in the right language to all those different places. I mean, King's Inter High, for example, has students in 60, 70 countries in any given year. The other one we see is in challenged geographies where you can't just sort of walk out the door and go to a bookshop. We're obviously excellent and differentiated there. So we know there's a market. We just need to attack it in a way that's going to work.
And then I've got another question here. In terms of gross margins, can you give some qualitative comments? Maybe one for Luke. Pluses and minuses going forward. You're saying you're like ramping up the spend. Obviously, that kind of pulls down margin maybe in the short term. But you're as you add more into the pie in terms of new schools and new courses, that's a positive on the other side. So maybe just Luke, maybe just touch on maybe some of those kind of key drivers on both ends.
Sure, sure. So look, across the sort of three businesses of the group, ebooks, we have had some margin erosion in the last couple of years, but that has stabilised, and that's been a deliberate strategy to basically win business. But that's certainly stabilising now, as the sales team's getting more and more traction, and so the need for discounting to win new business is less. The vet and schools, that's 90+% margin business. And the reason why margins are so strong is because we own all the IP, and we invest in all of our learning materials, well, for about 80% of our qualifications, that we own outright. And we certainly see that in the longer term, that margin will remain in the 90s. And Southern Solutions, we expect that margins will improve in that business. We have sort of restructured the trainer workforce within that business to drive some efficiencies, and we certainly expect that some of those efficiencies will start coming through in the second half of the current financial year. We're at 30 September year end.
Okay, and then maybe one final question, Luke, from me, just on that, being kind of out of sync with the majority of companies. Seasonality in the business. I'm guessing it's with the school year starting in January, it's more heavily weighted to
Absolutely.
the first half than the second half. But standard split? Is it like a 60/40 as much as that, or?
Yeah, look, it probably even more skewed, so 2/3, 1/3 historically, because two of the three businesses are aligned with the school year, being ebooks and vet and schools. But we certainly see that as the Southern Solutions business and our international schools businesses grow, that'll smooth out some of that seasonality.
Okay, yeah, because Northern Hemisphere schools, like
Yep, absolutely.
you'll be on the September start rather than the January start. Okay,
Exactly.
Andrew, Luke, thank you very much for joining us, and I see our second presenter has joined us as well. Sean, if I could just ask you to start sharing your slide deck, I will let you know once I can see it coming up here. It's just loading now, Sean. Yeah, and if you just want to go to slideshow present view. Yeah, perfect. Sean, you can take it away whenever you're ready.
Right. Okay. Well, first of all, thanks for having me, Mark, and hosting me. It's a pleasure to be here. So we'll just take you through our overview of the company. So the ASX code is AL3. Share price is trending around 14.5, 15 cents. Market cap is just under 80 mil. We have around 537 million shares on issue. And we have about 32.1 million cash at bank as of the end of December. In terms of substantial shareholders, Net Wealth Investments hold about 7.5%, and that's an aggregation of Canaccord shareholders. Andrew Sales has 4.8%. He's the original founder of the business. We have about 31% held by top 20 shareholders and the rest of the board and management. You can see we had a fairly big sort of price rise in around sort of July 24, which was on the back of some news in terms of expanding into the US. In terms of our team, so Noel Cornish is he's our chairman, and he's the former chief executive of Bluescape Steel and the former president of BHP North Star in the US. Myself, engineer by trade, I was the former chief executive of a company called CAMS, which we listed and converted to a company called Logicams in 2008. Then moved to Worley Parsons as the global M&A director for Worley's, and then joined the board of AML about 4 or 5 years ago. And more recently, in the last sort of couple of years, I've been the chief executive of AML. Andy Sales, our CTO and our founder, who founded the company in 2014, has very strong welding experience in terms of his capability set, in terms of what he brings to the company. Peter Siebels, a non-executive director, a former board member of KPMG, and Caitlin Smith, company secretary. So a bit about the company. So we combine welding, metallurgical science, robotics, and software into a system which we call the Alchemy system. That's our proprietary 3D printing system. It's one of the largest free-form turnkey systems in the world on the market. So it's pretty impressive in terms of the size parts that we can produce. If you look at the technology itself, it's patented. So we have a patent that we've rolled out now in Australia, New Zealand, Japan, and throughout Europe, and we've just pending in the US. In terms of the parts that we present, we print large industrial scale complex parts. So typically parts for manufacture for industries such as defense, oil and gas, and aerospace. And lastly, our systems can be deployed anywhere in the world. So you can pick up our systems and put it into a shipyard and really deploy it at the point of need. So what is wire arc manufacturing? So what it actually is it's using welding technology where you create a bead of molten metal, and then you use robotics to sequentially layer that metal on top of each other to form the geometry of the part. The real art in the technology is actually in the welding parameters and ensuring that you can get some really quite superior strengths over and above what you could do with traditional castings. In terms of our business model, there are 2 legs to it. There's a sale of systems and then the sale of parts. So with the sale of systems, a great example is the work we're doing for US Navy and Department of Defense in the US. They've got quite an extensive supply chain of manufacturers that are manufacturing parts for their supply chain for the submarine industrial base under the AUKUS arrangement, and we're supplying systems into that supply chain so that they can convert from traditional manufacturing into additive manufacturing. The second leg of the business is the sale of parts. So typically we'll produce parts for customers that don't want to bring the technology in-house, but want the benefits of additive manufacturing. And if you look at the typical size of the parts we produce, this one on the screen is a good example. It's about 1.5 meters by about 1.4 high, weighs about 1.4 ton. So we're talking, quite large industrial parts. In terms of the technology stack, there are 3 layers of technology plus the hardware. So WAMsoft is for engineers, and that enables engineers to take an AutoCAD file, import it into the system, and then it will deconstruct that part into a series of layers and figure out where to start and where to stop the printing to print that part. AMLsoft is for the users, for the operators to actually operate the machine, so they've got full control over the system. AML Rapid is our control system software, and that links the software to the hardware. And Alchemy is effectively off-the-shelf hardware. So we have aligned ourselves with a robotics provider called ABB, which is one of the largest global providers of robotics in the world. In terms of our revenue model, so we have 4 legs to that. We've got a capital sale. So typically when we sell a system, it'll range somewhere between $1 million and $3 million Australian. And that'll be a one-off sort of upfront sale for that. And then the customer enters into an agreement where we have licensing, maintenance, and production support annual fees. So typically license fees are to support the licensing of the software, which is the license of our core intellectual property. Maintenance is the maintenance of the hardware. So that's the maintenance of the robotic hardware systems. And production support is where we get behind the users of the hardware and of the system to help them actually convert from traditional manufacturing to additive manufacturing. In terms of the Alchemy range, so there's 4 in the range. The first one is Alchemy Education, which is for universities. So we've sold a number of those to universities throughout Australia. And then we've got 3 industrial versions. One's Alchemy Small Enterprise and Alchemy X. And they sort of range in size anywhere from about 2 meters in reach up to about 3.2 meters in reach. But our largest system, which we've sold, was actually a custom Alchemy X to a customer called Austal Shipbuilders. And that was an Alchemy X on a linear rail system, which meant that they could print up to 36 cubic meters of metal in one go. So it was quite a large system. That's actually being commissioned at the moment in the US as we speak. In terms of the benefits of additive versus traditional manufacturing, firstly, it's a lot less waste. So compared to billet machining, where you buy a billet and then you have to machine it and leave a lot of waste on the floor. In our process, 100% of the wire that we use in the system is used in the manufacture of the parts. Typically, our parts are about 30% stronger than traditional manufacturing, and that's largely because of the sequential layering of metal on top of each other, allowing the microstructures to bond together, so you get really good, strong, consistent strength right throughout the machine, right throughout the part. Next is it's typically about 75% faster or greater than traditional manufacturing. So a good example is the parts that we produce for the US Navy for the submarine industrial base program. We printed those parts in about 8 weeks, and traditionally it would take them about 2 years to have those parts cast. In terms of the markets that we operate in, largely about 90% of our business or more is actually in defense, and it's largely US Department of Defense. We have 3 streams of work. We have alloy characterization, manufacture of parts, and sale of systems. And that also incorporates the marine aspect of that, because largely that's all for marine applications. Thirdly, we have the aerospace sector. So we have what we call a manufacturing license agreement with Boeing, and that's with Boeing Defense for the design and manufacture of parts for one of their defense fleets. Oil and gas. So we've completed a project with Chevron, which is over in the US for testing. And energy is it's actually a new sector for us. And just before Christmas this year, we sold a $2.3 million system to Tennessee Valley Authority in the US, which is one of the largest power generation facilities and utilities in the US. In terms of parts manufacture, so typically customers will engage us to do proof of concept parts first before they buy systems. But what we're finding at the moment in the US is they're actually starting to skip that process and go straight to buying systems, largely because they've got confidence that the technology actually works. In terms of our new sales strategy, we've actually moved from being primarily a manufacturer of parts to primarily a manufacturer of 3D printed systems and parts. And that systems side, so if you look at our revenues for the last sort of 12 months, about 70% of our revenues are really generated from 3D printing systems. And that business model is actually quite successful for us and is driving sort of the growth of the company. In terms of blue chip customers, we have Blue Forge Alliance, which is the contracting arm of the US Navy. Oak Ridge Research Laboratory in the US, which is a center that the US Navy are producing parts out of using our technology. Boeing, I mentioned earlier. BAE Systems, we've just finished printing a large bolster ring for BAE Systems here in Australia. Austal, I mentioned, bought our largest system commercially available. Phillips Corp are our resellers and our partners in the US, and then Chevron's our oil and gas customers. In terms of our aspiration, we have now executed well on what we said we would do in terms of executing well on Oak Ridge and on the Center of Excellence in the US. And they were really core anchor sites to get our technology up and running and expanding in the US. What we are now doing is we're expanding into the US defense, land and air divisions as well. So we're looking for work in those spaces, and we've engaged a business development manager to focus primarily in that area. We're also expanding into oil and gas and aerospace in the US, and that's starting to build nicely. Next is we're looking to leverage our relationship with Phillips Corp across the US, and that's been building now for the last 12 months. Next is we've actually set up and launched a fully operational technology center based in Ohio. So it is actually a replica of what we have here in Australia. It's about 1,200 square meters with about half a dozen people and 2 Alchemy machines in the interest of entering the US market. We think the timing for entering the US market was right, with particularly with Trump coming in, the new administration coming in. In terms of certifications, so it's actually quite rare to have so many certifications as an additive manufacturer, but we focused on this because it ensures that we can produce repeatable parts for manufacturing. So we have DNV Lloyd certification. We have AS9100D for aerospace, and that's for manufacture of aerospace fly and non-fly parts. And we also have AWS, American Welding Society standards employed in the business. In terms of the US market, so the US market for us is where the majority of the action is going to occur. We've just launched that, as I mentioned, in December, and we've just finished a $30 million capital raise with about 12 million of that allocated to supporting the expansion of the US facility to capture the lion's share of the demand signals that we're seeing. We do see that the timing of setting up in the US was pretty critical for us, given the sort of reshoring of manufacturing and the bringing back of manufacturing into the US. We feel that that was really quite a critical move, which we made about 12 months ago, which is looking to pay off over the next 12 months. In terms of unlocking the US market, we have a system in Colorado with Cogitic, which is a defense contractor. We have 3 systems in with laser welding, which is based in Texas. They're another major defense contractor. In Tennessee, we have a system at Ornell, Oak Ridge, and then we have 2 systems, one for Austal and one for Center of Excellence in Virginia going in. And then you've got a head office based in Ohio. In terms of how we entered the US market, which most people tend to have an interest in, is we're actually reached out to by the US Department of Defense. And what they did was they actually invested in the technology and bought it in-house first. So our first major customer was actually the Department of Defense, US Navy. And then what they did is then they pushed the technology out to their contractors and broader industry bases, which is why you can see a lot of the work now is starting to come from sale of systems and manufacture of parts for those defense contractors in the US. This is just sort of, I won't go through this, but here's just sort of a quick snapshot of about 16 million of orders that we've secured over the last sort of year and a half, which covered defence and the Australian Defence Force. In terms of the cash flow, so for the second quarter, receipts from customers year to date is about 3.2 million. The majority of that was, like we were saying, sort of system sales and component sales. In terms of investment, we invested about 2 million in the first half in cash into setting up the US, and that went into about 700K of capital additions in terms of building out the facility and the machines that we needed to operate with. And then we have about 1.3 in working capital for the US over that half. Net cash positions 32.1 million as at the end of December, and we have about 15 quarters remaining on hand. So we're financially in a fairly strong position to grow from. Just out of interest, out of the 30 odd million, about 12 of that is allocated towards the US expansion. About 5 of that is allocated towards opening up a small facility in the UK or in Europe, because we're getting some pretty strong demand signals from over in Europe at the moment, which we want to capitalize on. And then we've expanded R&D by another 3 million and leaving about 10 for working capital. I won't go through customer testimonials, but that gives you sort of a brief overview of the company.
Thanks, Sean. Maybe if I could just start on the two separate businesses as a first question. I mean, long term, if we look out 5 years, do you still think the parts business will be operational kind of like as it is now? Does it fulfill that, I guess, key, how can I say, customer introduction where they lodge an order with you, they send you send them the parts and they can see, okay, this is like really good quality stuff, and we can actually look at like buying their systems. Does it still play that role in 5 years time, or will it, because they know their competitors are already using maybe your system, or they've seen the output from it somewhere else, that that contract manufacturing piece will eventually fall away?
No, I think it's going to be a combination of both. I think predominantly it's going to be driven by system sales. And then what it'll then be driven by is the annual revenue streams that will flow from that for licensing and tech support and maintenance support. But what we're seeing though is customers there are a group of customers that tend to want to have the benefits of additive manufacturing by getting it printed faster and stronger, but don't particularly want to own the technology. They're more of a purchaser, so they're happy to purchase it from someone. But in saying that, with the bigger customers, what we are seeing though, like the US Navy and like Boeing, etc., is that they want the technology in the business, so they're trying to engage their supply chain customers to purchase the technology so that they can be the provider of that additive technology to them. So that's where we see the sort of benefits, is actually selling into that supply chain.
Okay. And in terms of sales, and the licensing, is it all done in US dollars? I'm just thinking, we've had quite a move in the Aussie dollar in the last 6 weeks even. So I'm just trying to get a gauge on, a strong US dollar, good for you, bad for you. Maybe just give us a sense there.
Strong US dollar is good for us. Obviously, we're contracting in US dollars with our US clients, so it certainly helps. But at the same time, having a US facility, we're not repatriating, all of that back to Australia. We were actually using it to fund the growth of the US business. So it has been quite attractive, and look, our margins are quite strong for what we deliver. So we can weather a bit of FX movement if it does happen quite comfortably. But at the moment, the majority of our contracts are all in US dollars, which is correct.
Okay. And then the location of the US HQ in Ohio, I'm just wondering, where that came from, because I know Austal shipbuilding thing is in Mobile, Alabama, and I know, the US Navy is in Norfolk, Virginia, and Annapolis, Maryland. Ohio, I think, is a landlocked state from what I remember. For somebody who does a lot of work with the Navy, is there some other reason it's there? Is it kind of a center for additive manufacturing or welding in the US? There's a lot of other it's kind of a little mini ecosystem there.
Yeah, it is. It's actually a bit of an ecosystem for additive manufacturing. So the University of Ohio is I think it's one of two welding institutes in the world that are really well renowned for their welding technology. And given we're a welding process, having access to skilled capability was really at the forefront of our minds. But in saying that, we also consulted with people like the US Navy and our aerospace customers and oil and gas customers on the location. And Ohio just seemed to be somewhere around about the sort of middle of where everyone was sort of based, and it works quite well for us. I mean, in saying that, we also have a business development person based in Houston. So he's close to the oil and gas sort of activity centers down there. What we'll probably look to do moving forward is, with the capital that we've raised, is we'll look to set up a second facility. And we're just sort of considering where that second facility would make more sense to be located. So we are looking at potential sites in Danville, around that area, which is where the Center of Excellence is for the US Navy, and a few other locations as well.
Okay. In terms of the licensing, is it an annual license, or are people kind of contracting in on a 5 year basis? So obviously you've got the upfront cost of the hardware, a bit of training and support at the start, but in terms of the licensing agreements, how long are they typically set out for?
Well, it sort of varies. I mean, it's typically an annual license. So it's an annual license for licensing the software, annual license for maintenance, and annual license for tech support. But some customers tend to like to bundle in, 2 or 3 years into the upfront sort of capital purchase of the system, just because it makes it easier for them to procure it. And then some prefer to pay it annually, as the time lapses. But it's actually pretty core to us. And what we sort of say to the customers is, and this is why they keep coming back for the license fees, is we're always updating the number of alloys that we've got. We're always updating the geometries that we can print. So that keeps the system, up to date with the latest tech year in, year out, as the system sort of, builds itself out.
Okay. And in terms of, you mentioned R&D, the split maybe between R&D on, the software side, as you just mentioned, versus, building either, another machine that, can do even larger parts, or just refining of the three models. I'm sure AI comes into it as well, in terms of both the robotics piece and the software piece. The advances we've seen in that in the last 2 years. Maybe just touch on the split of the R&D.
Yep. So with research and development, we've got a technology roadmap for the company. and that stretches out for the next 2 to 3 years. So that lays out all of the technological aspects of the system that will be built out over that period. So that ensures that we keep at the forefront of development of our system. One of the major developments we're doing at the moment is we're investing 2.4 million into building out what we call a twin wire dual robot system. So that's, if you can imagine, a two-story robot and having two of them print opposite each other from either end will double the capacity and double the print speed of what we're able to do. And then we're also engaging an R&D program on twin wire, which means we can print twice as large and twice as fast using the new twin wire system. So that program has just kicked off. 1.2 million of that is being funded by the state government. The other 1.2 million is being funded by the company. So that program is due to, or it's kicked off now, and it's due to complete in about 16 months.
Okay. Yeah, because I see we had a question here on R&D strategy going forward. They were talking about the natural limitations of wire arc, but I think you've kind of given some good insight on where you're going. Pipeline, Sean, I know you have quite a back order of stuff that's kind of come in the last 6 months that's going to be delivered over the next 12 months. But in terms of you've said new inquiries on the international side, but yeah, maybe just give us a sense of how the pipeline is building compared to maybe this time last year.
Yeah, well, our pipeline's probably doubled in the last 12 months compared to what it was like last year. A lot of that growth we're seeing is really coming out of the US, and that's largely because we've obviously set up the facility in the US, but we have 3 people full-time on business development, just focusing on building the market out in the US. The next thing is we're seeing a lot of interest coming out of the UK through the AUKUS arrangements. So we're seeing like large shipbuilders reach out to us and want to engage us for doing some alloy testing and characterization work with an interest of moving into parts and then systems. So the UK market will be quite interesting for us moving forward. So we're seriously looking at putting or setting up a small location over there to get in front of that opportunity.
Okay. And you touched on the reasons for setting up the base in Ohio and pulling the trigger on that, obviously with the new government coming in. There's been sweeping policy changes in the first 3-4 weeks. In terms of kind of what you expected and noises that are coming out of the Department of Defense since the new administration has come in, is it kind of what you were expecting? Is this lining up as kind of you kind of had envisaged? And will it fast forward kind of the plans for what Defense wants to do in terms of your business?
Yeah, it's a great question. So what we expected was that when Trump came in and the new administration came in, that defense would be one of its forefront sort of areas that it would focus on, and that seems to still be the case. So we're expecting a lot of support for defense budgets and progressing defense moving forward. The second thing, which I think has been pretty encouraging, is this reshoring of manufacturing, so bringing manufacturing back into the US. And we can sort of see that by imposing tariffs on other countries, that's going to make the US quite competitive domestically for what it can supply to itself. So we felt that it was really quite important that we effectively took our business and set that replica business up in the US to capitalize on that. So we're sort of insulated from that tariff barrier by having that US business, up and running and in operation. And that's really why when we went and completed that last raise to expand, the expansion would largely occur in the US to support that sort of reshoring of manufacturing.
Okay. Sean, we're just about up on time. I think we'll leave it there. Thanks very much for taking the
No
time this
problem.
morning to join us. It was good to hear the story firsthand. I know we had a one or two false starts at the end of last year to try and get you in, but we got there this morning. And yeah, hopefully we can get you back in later in the year. It'll be good to hear how the Ohio facility is progressing and yeah, how you capitalize on some of the pipeline opportunities.
Sounds good. All right, great. Thanks for having me, Mark.
No worries. And with that, we're going to leave it there for this morning. Thanks everybody for joining us, and I wish everybody a good rest of their Thursday. Thank you.